Well, the second quarter results did come in a little bit better than expected. Initially, the thought was that earnings would be down almost 46% year on year. Now that number is likely to be closer to a 40% decline, but that's still a pretty deep shortfall year over year. I think the big concern is that we didn't really see much of a change to 2021 earnings growth expectations. Actually, they came down a little bit. They were expected to be up about 31% at the beginning of the quarter, and then now expected to be higher by 28%. So I guess the enthusiasm related to second quarter results did not carry into increased forecasts for 2021. I think that in the month of August, the market could be vulnerable to some sort of setback because of what I call a convergence of concerns. There are a lot of concerns out there that I think, if they all come together, could cause investors to want to take some profits. In particular, the market is overbought from a technical perspective. Investors are continuing to get concerned that the tech stocks and the very, very large companies are directing the market. Concerns over the message coming from rising gold prices, a falling dollar, and record low interest rates, as well as seasonality. August and September are among the two worst months of the year for the S&P 500. I don't think that investors would wait to see consumer spending to then decide to take some profits. I think that they might end up, you buy on rumor and then sell on fact. So you buy on the rumor that the Congress will come through with some sort of an additional stimulus plan, whether it's $1 trillion, $2 trillion, or even $3 trillion. But then once that has been enacted, chances are that Congress is not going to come through with any more. So therefore, because of that, we could end up seeing the market start to take some profits. The gold prices, I think, went up for four reasons. CIDD. C for concerns over the coronavirus, I for interest rates, D for the dollar, and then D for deficit, and the worry that that could then trigger inflation. I think that the reason that gold is coming back is because it hit a major resistance level at $2,000. And usually, like the stock market, big round numbers tend to act like a rusty door and require several attempts before it finally swings open. So I wouldn't give up on gold just yet for the reasons that I mentioned, but I think it simply is a trading situation where investors sort of take profits at millennial levels, but then gold will probably gear up to try to break above that level once again. The belief is that in the coming year that the dollar could continue to weaken. So as a result, we think that gold, but also international equities, could be among the beneficiaries. Energy prices as well. Those things that are priced in dollars could benefit. Also, some of the large international companies that are found in tech, energy, and industrials could be beneficiaries because their overseas earnings translated into US dollars will benefit from the weaker dollar.